At one point, 777 Partners was connected to an investment empire worth billions. Today, it sits inside a bankruptcy fight involving roughly $2.7 billion in funded debt. How does an empire that once looked unstoppable end up here? The bankruptcy itself is a matter of court record, but the path to this moment is found in the way the empire was constructed. Operating out of Miami, 777 Partners presented itself as a rapidly scaling investment firm. They built a reputation through a series of high-speed acquisitions, accumulating a vast portfolio that appeared impenetrable to outside observers. To the financial world, they were building an institution designed to remain resilient through every phase of the economic cycle. On paper, the strategy of creating a highly diversified investment empire is a compelling pitch. By placing capital into unrelated industries, a firm creates a theoretical hedge against market volatility. If one sector experiences a downturn, the profits from another serve as a buffer. This vision attracted investors and business leaders who saw an opportunity to participate in a massive, diversified growth story. The firm's growth relied on a core operational strategy, buying an array of businesses across radically different sectors to reach a massive global scale. They were building an interconnected ecosystem of assets that ranged from finance to global travel and live entertainment. Joshua Wander drove this aggressive expansion. As the central figure behind the firm, he was the face of an acquisition strategy that moved faster than many in the industry thought possible. The deals continued to close, and the portfolio grew. But every investment firm faces a limit on how many massive, complex bets it can manage before diversification turns into dangerous overextension. Unchecked expansion creates extreme operational friction. Managing vastly different industries simultaneously requires deep expertise and constant oversight in every single sector. Without that level of control, the complexity of the organization can quickly begin to outpace its capacity to manage it. The scale of that complexity became clear as the firm moved into the global aviation sector. Aviation is an industry known for its extreme volatility, high regulatory hurdles, and extreme sensitivity to economic shifts. 777 Partners took major positions in budget carriers, including heavy investment in Canada's Flair Airlines. Scaling an airline requires massive upfront capital for aircraft leases, fuel hedging, and meeting strict federal safety standards. The economics of the airline industry offer almost no room for error. Profit margins are thin, and a single spike in fuel prices or a labor shortage can erase a year of growth. It is a business that demands operational perfection and constant liquidity. Their Australian play, Bonza, faced similar pressures. These airline investments require immense amounts of cash to remain operational. When seats go unfilled or routes are delayed, the overhead costs remain fixed and unforgiving. Owning an airline fleet necessitates a massive, uninterrupted flow of liquid cash to handle daily operations. Fuel must be paid for, crews must be compensated, and aircraft leases must be serviced. Regardless of the assets listed on a balance sheet, the daily reality of aviation is defined by cash on hand. Parallel to the airline expansion, the firm moved into professional soccer. The global game offers access to massive international audiences, broadcast media rights, and significant brand equity. The strategy involved acquiring multiple clubs to create a global network. Theoretically, these clubs would share scouting data, transfer players within the network, and pool commercial sponsorship opportunities to drive up the value of the entire group. Professional sports carry significant financial and public pressure. Owners must manage the expectations of passionate fan bases while funding expensive athlete rosters and paying millions in transfer fees. If a team's performance drops and leads to relegation, revenue streams can disappear almost instantly. As the firm's global footprint reached across continents, the underlying financial structure became a web of cross-collateralized risk. Managing a portfolio of soccer clubs and airline fleets simultaneously created a level of fragility that would soon be tested. The firm began to face a tightening liquidity crisis. For any investment company, capital is the lifeblood of the operation. When that flow slows down, the pressure on every single asset in the portfolio increases. Financing pressures mounted, leading to disputes with creditors who claimed they were not being paid according to their agreements. These disagreements began to move from private offices into public courtrooms. Regulators began to take notice. According to SEC allegations, the firm raised approximately $237 million through a preferred equity offering. The complaint alleges that the money was raised using disclosures that failed to accurately represent the firm's financial status to investors. There is also the matter of a $300 million credit facility. A credit facility functions as a massive, flexible loan used to fund daily operations. When a firm faces allegations of irregularities regarding such a large source of capital, the entire foundation of the company comes under scrutiny. The legal pressure extended into federal court. Prosecutors have alleged criminal conduct involving approximately $20 million. It is important to emphasize that these are allegations, not criminal convictions. Joshua Wander and the firm have the right to defend themselves against these claims in court. When complex corporate structures begin to break down, the result is often a systemic failure. The combination of SEC civil allegations, federal criminal allegations, and widespread creditor disputes creates a level of scrutiny that can paralyze even a multi-billion-dollar operation. These individual disputes culminate in a single massive figure. 777 Partners is currently facing roughly $2.7 billion in funded debt. This illustrates a fundamental rule of high-stakes finance. $10 billion in assets under management is distinct from $10 billion in usable cash. You can hold titles to airplanes and professional soccer teams, but those assets cannot be used to pay a legal settlement or a payroll tax on short notice. This condition is known as illiquidity. It is the factor that ends empires. If a firm's assets are locked away and cannot be converted to cash, the company loses its ability to meet its immediate obligations. Leverage magnifies both growth and decay. Borrowed capital allows a company to expand at breakneck speed, but it requires consistent, reliable repayment. Billions in paper valuation offer no protection if a firm cannot meet its daily cash requirements. This brings the story to Chapter 11. In the American legal system, Chapter 11 is a court-supervised restructuring. It is designed to preserve the value of a business by allowing it to reorganize its debts under the oversight of a judge. The process involves creditors competing for the remaining value of the firm. It often leads to asset sales, where the soccer clubs and airline interests may be sold off to new owners. Meanwhile, the SEC and federal proceedings continue to move through the court system. Bankruptcy marks the start of a lengthy legal autopsy. It is a years-long process of uncovering exactly where the money went and determining what value remains within the complex corporate structure. The collapse provides several clear insights for anyone tracking the world of high finance. Assets on a balance sheet are not the same as cash in the bank. Diversification without operational control leads to overextension. And in any business, cash flow is the ultimate measure of survival. 777 Partners began with a vision of massive scale and global influence. They acquired the pieces of an empire, but eventually the weight of the structure became too much for the foundation to hold. Every massive enterprise must eventually answer for its own complexity. If you were building a $10 billion investment portfolio today, would you spread that capital across volatile sectors like aviation and sports? Or would you focus your resources on a single, stable industry? Which path would you choose? If you want to see more investigations into the rise, the fall, and the underlying financial mechanics of the world's largest businesses, subscribe. We look past the immediate headlines to find where the money is actually moving.